Okay, so I'm going to start with these slides that I put in the chat. This morning, we talked about the potential for a call wall up above. This morning's conversation was largely about pinning, not so much about specific intraday mechanics. It's been a repeat of the last couple of days. We've seen the same type of thing show up where we have large ranges of neutral gamma with a pretty significant concentration of dealer long call gamma above the money. And my base case has been a rally. I have felt this way since we've cleared 5,300 for a number of reasons that I articulated today in a document that spelled out my path. That'll help keep us accountable and also check to see which types of flows kick in and which don't. Today's rally was pretty significant. I would expect that because we've had some pretty high realized vol days this week, that the case for vol control funds to re-enter the market next week is going to be pushed back. That would have been a pretty perfect threading of the needle for a lot of mechanical flows into the end of next week, but I don't think that there'll be enough for vol control to come back. So in the morning, the consideration was really for a rally. That was the base case. A lot of the event vol has come out. So two things happened. We had a vol shock that lifted the tail significantly, added a lot of put delta below the money, as vol has collapsed both on the back of being sold from the spike, but also just mechanically as event hedging for all this macro data that's chunked together on the calendar this week. That's helped lift the index as well as people clear the deck. Air comes out of, especially the put side of the tails. That's Vanna. And Vanna is essentially the idea that delta is changing as implied vol changes. This profile here is the traditional dealer profile. This is gamma. Similar profile would be in play right now. On the Vanna side, as you drop the vols from these options, that lift has helped buoy the index. Sometimes it seems absurd to think that just this delta influence can move the market significantly. But again, it's all about having a passive type of imbalance in the market, and especially on the back of these moments when there's not a lot of other flows in market. And so every day this week, the same types of recaps keep coming out from the different prime brokers and flow desks that volumes are light. Whenever volumes are very light, other mechanical flows can really get in the driver's seat. As we come out of this weird vol shock event, and a lot of these mechanical flows and influences of hedging flows as the curve readjusts, a lot of that will naturally drive the index higher. And we've seen these V bottoms get sharper and sharper. If you're sitting on the sidelines, it becomes painful to watch the rally, and you start to think that everything's okay. All the risk is gone. And so the real strange path would be an overshot to the upside, followed by VIX squeezing through dealer inventory. Dealer negative gamma works in both directions as well. So if we overshoot the downside in VIX, that will eventually have a strange kind of mixed signal type of thing going on where vol looks really low. The index has reclaimed its highs or gotten very close to it, just as we've gotten through all this macro data, but we will be entering a seasonally weak period again. And Powell has a lot of room to disappoint. If we're trading 51.5 or 5,200 and we go into Jackson Hole with any kind of ambiguous data or looking for certainty, it's much easier to resolve that uncertainty with more allocation to equities. But now, after already reclaiming the highs, it's going to be difficult. A lot of the dangerous path could be resolved if we get a little more sideways action and we don't get a retail chase in and a spot up vol up after the VIX expiration next week, but we'll see. If we get a really low VIX print on Wednesday, as well as spot up vol up thereafter, I will be backing up the truck with puts. Otherwise, I would be sidelined and waiting for an opportunity to show up in September. If we do get an overshoot, in my opinion, the overshoot would be largely technical, and it would be capped off by this likelihood that retail will chase at the top after all the mechanical influences have already resolved. But that said, a lot of the buying flows that would get us back to the starting levels have clearly already happened. We're almost to the all-time highs already. And so all I'm saying is that if we do complete this sequence, my conditional path, it would, when these things trigger all my different things, I really look as that as an opportunity to get into risk for cheap. A very good time to hedge, in my opinion, if this happens. And when I say back up the truck, I'm just saying I will buy as many puts as I can afford to do within reasonable bounds. And not just puts, obviously. I'd like to trade different types of structures, but that's not really the type. That's not the point of the conversation here, but we'll talk more about that on Saturday too. Both the sequence that I started in June, evolved throughout July, and then capped off a little bit early, maybe in August, but mostly was a good trade. Okay, and so back to what happened today, this conversation on pinning. So just a quick recap. These are in the slides tonight too, because maybe you guys didn't see the call this morning. But just to reiterate, the discussion on pinning, a lot of people misallocate or misattribute the rationale for why options pin or why markets pin option OI. The point I want to make is that this is not just me saying this. I respect Sinclair a lot. We disagree on some fundamental things. I haven't talked to him personally about any of them, but very much I'm aligned with exactly this, and I respect his approach to markets considerably. But pinning effectively is just an influence. It's what happens when gamma and charm interact into expiration. It's not intentional. It's not manipulative. It doesn't even benefit the dealer if you think through the mechanics. It actually works against the dealer in many ways because the dealer's flows in the underlying have work to put the position in a place that's suboptimal for the dealer, but it is what it is. And it's also not independent of the dealer's longs and shorts. There was a call the other day where someone explained pinning, and the way they explained it was that it happens because some dealers are buying stock because they're short a call above the money, whereas some dealers are selling stock because they're long the call above the money. That's a very naive way to explain pinning. It's not really what's going on. Pinning depends critically on the imbalance of dealer flows. And so if a dealer is short the option, pinning will not happen mechanically. It actually has the influence of pushing the market away from the dealer's short. It just does not have any gravitational pull to it. Now, that's not to say that there's not some kind of external or other factor going on, because obviously there's another side of this trade. We assume that the dealer is the hedger in this two-way game. We try to control for that as best we can, the way we construct the data set, but the dealer is the hedger. The other side is not the hedger, but the other side does have an interest. And so once we get to their level, they may monetize, they may roll a position. There might be a mean reversion if we go through their level, but the chain of causality is not correct to say that's what's happening. That's just a constraint that we can't model the entire end user response function. We can just know with pretty good certainty what the dealer has to do. This was the example that we discussed in the morning call. It's interesting because it was July 24th. To anybody who would say that, oh, it's always easy in retrospect, I will put the link in the chat because it was my first time doing any kind of call or YouTube thing or whatever. Somebody asked me to do it, and I figured, why not? That day around 1 o'clock, I explained exactly why I thought that the case for closing at 54.30 was pretty strong. And several hours later, that's exactly what happened. And so I'll put that in there because it was the same type of explanation here. The more you think about this, the more obvious it becomes. I've just lived through it so many times that it's very intuitive to me. Just to recap briefly, we slide through. This is negative gamma. This is positive gamma. This position is the dealer short put spread. You can see this here. This is customer inventory, right? Customers long this put. Customers are short these puts. When I say short 54.5 put, long 54.30 put, I'm simplifying these maximums. This contributed to the negative gamma the dealer has here. This is the position that I was pointing to. This is what the dealer had on. Now, again, this is customer labeling. The dealer has the opposite, and you can see that very evidently in the gamma profile. This is the 54.5 put right here. 54.30 range is right here. And so the reason that I had a high degree of confidence that we could see this, even though it was a strange call because everybody thought we'd bounce, because if we didn't bounce, we would break that record of longest time in market since 2007 without a 2% crash. I had nothing else to go on, but I looked at the map and I said, okay, this is what's going to happen. You slide into this range. You can see the evolution of the gamma profile. This is literally color. The color changing is literally a representation of what's called color, which is the change in gamma with respect to time. So as the day goes on, the 0-day position becomes much more influential. And only here does it even seem to have such a strong influence on the underlying. And this one is, of course, the same thing. It would have been very important to hold this level because slipping through the strike price meant that as we go lower, the dealers have futures to sell because it's negative gamma. But this seesaw effect, because they have positive gamma below spot fairly quickly, it balances out very fast. All the futures are selling here because of negative gamma, they're buying. Now, I know that sounds good because, oh, they're selling higher and they're buying lower, but that's actually not true. There's nothing positive happening yet for them because remember, they're selling delta against a put that when they're selling the delta is moving from 50 delta to 60 delta to 70 delta. But if they stay here, they wouldn't have hedged the entire thing. And they're buying delta against the put that is 30 delta, but it will go from 30 to 20 to 10, etc., and be worth nothing if they don't go through it. So for the dealer, if they do go through this put spread, they want to have a lot of movement around this strike where there's gamma scalping, etc., and then come back and somehow close near this strike. But what the dealer is doing makes this difficult for that process to work in their favor. Because again, if you go through and now you're below the strike, let's just say you're right here. And we'll assume for simplicity that at this moment, the 54 hat put has a 70 delta. And again, for simplicity, we'll just assume that this lower put has a 30 delta. Now, as time passes, those deltas are quickly going to do two things. The put the dealer is short is going to go from a 70 delta put to a 100 delta put within an hour and change. And the put the dealer is long is going to go from a 30 delta put to a 0 delta put within the same time frame. And so the dealer's hedge right now is they're short not enough futures if this is going to be a 100 delta put, and they are long too many futures if this is actually a 0 delta put at expiration. And so against this one, they have to continue selling futures to make their hedge closer to 100 because it's becoming a 100 delta put as time passes. And they have to continue selling out the futures that they owned against this put because this put is going quickly to 0. And they are left with not enough hedge for this short put and hedge against nothing here with their long futures. So they have to continue selling futures, which obviously pushes the market back down. And now in the process of pinning, there's still two things happening here. This is why I say it's like a slowing and a trapping. Let's just assume that first descent towards the strike price, 54.30, before the final expiration or whatever. Let's assume that we actually plowed through. And so now you have a couple of things happening. If we sell through the strike price, obviously you guys know the maximum gamma is on the strike price. This whole range, though, they'll be buying additional futures against gamma. Now, if the market stops and nothing's really happening anymore, the flow dries up and we're sitting below the strike price, let's say that strike is a 65 delta, there's only 15 minutes left. It's going to quickly become a 100 delta. So the dealer will have to buy futures as time passes, but there's still gamma on the strike. And so if the market moves as a response to their futures buying, they'll actually have to sell some futures out. And then if they're still below the strike, time passes again, they will have to again buy a little bit more delta because that put's becoming a 100 delta put, but they're only hedged at 65 or 70 delta. And then if we rally again towards the strike, the delta drops again. There's this gyration. It's like a stair-stepping function. It's a gyration or something where they've slowed the descent from the natural exogenous flows. If we've gone through, then it actually catches it and traps it back on the strike. And if we didn't go through, they have to sell out all the futures that they bought. And it's the opposite. It's just a selling out of those futures instead of a buying of them. But the same thing happens. You can go through this a million ways. The end result, if the dealer is dominant in the market, is that they'll land right on their strike price. And that's pretty crappy for the dealer. I just want to take one question or two here. PS says, and this is only for puts at expiration, right? No, this is in general a dynamic that happens technically throughout time. It's really similar to what Vanna does to an option. Charm is very similar to Vanna, but this is obviously most in effect at expiration because Charm is the decaying away of the option delta, and that is always going to be most significant at expiration. But it's not puts, it's anything, it's calls, etc. And it's technically going on for any option, right? So like when there's a one-day option, it's actually happening too in the background, but it's so benign and difficult to notice for a one-day options delta to go from, let's say, negative 19 to negative 17.4. You're just not really going to notice that unless the position is gigantic. Typically, those features like that, Vanna is more important sometimes because a big vol move, a big implied volatility move, will have a larger impact on delta sometimes than Charm will for anything with more time to expiration. And yeah, what you're seeing here, this evolution of the color, is usually when you see this type of thing on the options depth charts, this is almost always coming from 0-day options. And as we get to expiration, that's when it's the strongest. Okay, so this is today's position, right? And so ignore this stuff. This giant bar looks really cool. I should have clipped it because it was irrelevant. 5600 was never in play. This range here is what mattered. This is actually very much like yesterday's inventory. But if you look at the range here, you can see this is very interesting. It's almost like a laddering. This has shown up a couple of times as well. Interesting feature. It's like an ascending stop in the market. And I don't know, I can't speak to any strategy in play that would land this way. It seems odd. Now, on these lower volatilities, even this alone, the 5540 calls, for example, would have an effect of placing a pretty obvious call wall on the gamma profile, which I'll go back to in a moment. But when you see this, obviously, it's a stranger kind of feature where it's going to be an increasing amount of gamma. So this is a really, the dealer's position in the end would have pretty high speed anyways because of this, but this structure is even higher speed, meaning that all these options are becoming significantly more influential as far as gamma resistance goes because their deltas are coming into 20 plus as we get through really right here. And so if you were to look at this, you don't even need to know what the gamma profile is. You just know that, oh, wow, there's a bunch of dealer longs. That's going to slow price significantly. So let's just go back really quick. This is today, right? And so if you go here, 55.40 is right here. And again, there's no perfect stop, right? I hope I made this clear. There's never a perfect stop. The only thing we can ever do is try to find evidence of influence where we can say there should be a footprint here. There should be a force in play where there's going to be a little bit of a tilting of the odds in our favor if we know where to find it. Because obviously the option surface can't adequately price all of these. There's a lot of nonsense that goes on the dealer side. We would do some ridiculous things with inventory marking and local like splines and all these things you can do with the model. But at the end of the day, all those distortions don't really move the needle in terms of the implied odds for the raw bet. And so if you can have a little bit of nimbleness in your approach, you get some really good outcomes when you can understand why certain levels should be respected or why certain behavior shows up in certain ranges. It doesn't mean that it will always show up. And it doesn't mean that it will be dominant. For example, today, I think a lot of questions I got today were along the flavor of why would this continue to go higher? Pretty obvious. There are more buyers. This is significant conditional selling on the gamma side, which is a real feature in the market. It also faced serious buying flow, whatever it was. And this is funny because the more I look at this, the more I see the same pattern show up. What you have here is an asymmetry in the dealer's hedging of long gamma. Let's just say I'm the market maker, okay? If I'm looking down at my risk report, what's happening here is my position is such that if we go up, let's say $10, I might have 800 minis to sell. Whereas if we go down $10, I might have 200 minis to buy. There's a big asymmetry along this path where, yes, my position is long gamma, but the distribution of that gamma is completely asymmetric. And that asymmetry is actually a representation of speed. As we go higher, it's like a perfect meme too, because you get these high speed collisions into a call wall, where the higher degree of asymmetry is, the more quickly you run into a solid structure. Obviously, if all of a sudden 800 minis on every $2 increment shows up, that's serious force in the market to stop the flow that's been moving it through this range of really light book depth. All of a sudden, the book gets very deep here, but mostly on the offer side. Now, gamma obviously is a two-way thing. So as the dealer sells a lot of delta into the rally, sell-offs are met with some degree of buying back of those deltas, of course, right? Like in this dense, dark channel here, there's very strong positive gamma flows in both directions at that point. The interesting points are usually along these changes in gradient that are reflective of higher up gamma than down gamma, as Taleb calls it. But in any case, to round that point out, if ever I'm fading a call wall, meaning I'm selling call spreads or buying puts because I presume that we'll bump up against this and fade off, it's really the third time's the charm, and that's when I get out of the way. If it comes up against it and fades off and then tries again and still rebounds, this is the point at which I say, okay, I'm giving up on this one. There's something bigger in force here. And sometimes we go through these in really swift fashion because obviously there's asymmetry here too. Once you get on the other side of this local maximum, there's negative speed in the market, which is a simple way of saying that the opposite of this thing happened. Now the asymmetry is to the downside, where the dealer is going to provide increasing support if we sell off. But as we rally, the extent of their gamma hedging flows to the upside, where they are suppressing the rally, it increasingly dissipates. And you can quickly run away from your spreads. And so this happened today, again, very similar to yesterday. Yesterday had a very similar structure on the dealer books as well, an ascending call ladder or something like it. And here again, we accelerated, slowed, and finally trapped. And this produced a pretty miserable trading range for most of the day. And eventually the range really compressed. Now, one thing I want to point out, because this question gets asked a lot and it's worth considering, we're looking at a simplification, right? So when you look at these dealer inventory profiles, what you're looking at is a simplification. It's the netting of all of the inventory on a certain account type's books. But among all of that, some dealers are long, some dealers are short. End users have a mixed bag of their own approaches to managing inventory. And then, of course, there's still zero-day stuff going on, too, where you're going to see a lot of mean reversion, and probably even more so as people shift from ES into zero-day options if they're not friendly on margins. But zero-day traders unwind positions that are working for them. So you almost have to discount the gamma from intraday trading. In any case, the point I want to make here is that what's going on here is noisy. The fact is, There's probably 700 plus entities that qualify as what you call dealers. Any number of them might have a position in this one contract or the contracts around it, and it could be a massive open interest that nets to a result of 100 net long across those types of accounts. But the fact is, there could be all of this complexity underneath. These guys are all hedging their positions largely into the futures market. Even if the end of the day they're netting out, their hedging flows aren't netting out. They're still hitting the market in some form or fashion and not crossing temporally or at the same levels. You're going to get a lot of noise at expiration always. In these last 10 minutes, we've been getting bigger and bigger moves, more erratic moves, but we get some strange looking charm influences. This shows up very often around the most influential nodes on that final position. Sometimes it surprises me. I'm like, there's no way this will happen again. And then sure enough, you should buy this or be ready to have a small kind of lotto bet into the close when we have these strange moves, but there's still a lot of charm influence. I'll talk about the AM Opex position in a moment, but first, Teo says, how much intraday gamma changes affect this heat map? I think what he's saying is how much changes there intraday due to all the volumes that you see. There's a ton of intraday volume. And the intraday volume is hard to make sense of. And it's just a little bit of context. So as a derivatives market maker, you see a lot of stuff that happens that's very noisy and in a sense meaningless. What I mean by that is, let's say you start the day and we're trading 54.75 or something. Any given day, someone will enter the cob and sell a bunch of out of the money flies, out of the money spreads, and you see a ton of it happen back and forth. What that does is it produces a massive amount of volume on the strikes. For example, if there's a QIS strategy that comes in to sell the 55.30, 55.40, 55 half call fly, for example, and it trades 2,000 times, that all of a sudden is 2,000, 4,000, 2,000. You have 8,000 in volume on those three strikes already. And that was just a trade that somebody sold the tiny spread at 20 cents and somebody bought it without even thinking twice. Completely meaningless in a lot of ways. And if they buy that back then at the end of the day or midday, then effectively you've doubled that volume. And so you can see how when you have flies and spreads and structures that are multi-legged, all trading at small premiums, those types of structures and strategies really amplify the volumes that you wind up seeing in the end. So don't think that every contract that you see is some net imbalance or something that's very intentional with respect to direction. A lot of it is just noisy flies and condor type structures. On the other side of that, a lot of the 0-day trades, there is intraday flow. And I do suspect, because of some recent changes under the surface, that we will see a lot more mean reversion because the intraday flow tends to be unwound. As you see these mean reversions, those may be indications or footprints of these intraday directional traders. Another question somebody asks, if you have access to a real-time data feed, what do you look for to determine what is customer versus dealer bought and sold? At that point, it gets a little bit noisy. There's a lot of dealer on dealer flow too, just because it crosses markets. There is the CBOE tagged data series that the options depth guys are working on, but I think that I'll definitely be watching that intraday. You can see the evolution of the customer footprint throughout the day because they'll release a 10-minute slice. So every 10 minutes, they come up with the updated position. And so it's not real time per se, but it's pretty useful in the sense that you're getting updates in an actionable time frame for intraday. And then I was going to say here, the other thing I want to say is to that initial point too, when a lot of the inventory is closed, that again speaks to this idea that a lot of the intraday, 0-day flows, whether they're used by dealers or firms or customers in the end, a lot of those flows are closed same day. And so that does produce mean reversion oftentimes, and it often nets out. So of course, like you could have a 20,000. I used to laugh sometimes because we'd have a big move in the market and maybe one of the banks or somebody would put out a flow note that flagged like a big 0-day trade, like a big block. And it wouldn't be more than 48 hours before the CBOE had some kind of like really dressed up, buttoned up PR piece to explain how, no, that wasn't us because look, at the end of the day, it all nets out. But that kind of betrays the obvious kind of point that like, okay, if you're showing me an end of day data set that nets out, but customers unwind trades, what does it matter? You're missing the meat in the middle, where if somebody came in and bought 20,000 puts that became in the money, but then they sold them, It's a bit of a misdirection to say that because it netted out in the end, there's no problem. Obviously, the convexity intraday, the gamma, can be problematic for the market. And I think we've seen a little bit of that really explode in the VIX option complex. And I'm watching with a close eye because they're doing some strange things on the margin side and the exchange side that are really interesting that you don't usually see articulated publicly. But whenever you see clearing firms make sudden changes or a rush to cover, patch some certain holes, it's never a good sign. But anyways, I'm going to move on first to just tomorrow's Opex. So this is that open close volume summary output. SOQ, so that's special open in quotation. This is just tomorrow's AM expiration. August serial. What you look at here, this is a chart of all the strikes in range. It's remarkably balanced because a lot of positions are probably already closed by today. And given this, I wouldn't necessarily expect a massive move, but you see some of the larger positions in play, right? We settled right around here. The closest strike, I think, was 55. I don't have it up. 55.43. Mikey P, I think, made a good amount of money on the print. If he remembers it, I'm sure you could just type it in, but it was like 43 maybe. Okay, so yeah, so this is about where we closed, right? And this is interesting. Now, along the lines of what we were just discussing, if this is the market maker book, we have a pretty worrisome position on our hands. Now, there's some ambiguity about who hedges what, and so I like to look at a couple of different constructions. Personally, when it comes down to a serial Opex, I tend to imagine that broker-dealers and firms are acting as dynamic hedgers as well if they have inventory they're carrying into settlement. So I tend to break this down a little bit differently and just look at the opposite of the customer base explicitly and assume that anything that's left on broker-dealer and firm book is also hedged accordingly. And so we may see this tomorrow might be a good test of my own theory as well, because this would be strictly the opposite of every other entity, whereas this is what I would consider to be the Opex hedging brigade, for lack of a better term here. And so what is you have a potential thrust to the upside if this is a position, but I think it's more like this. I think we'll have resistance to the upside, not huge, but something. Most importantly, though, is this here. That should be obvious. That this should stick out like a sore thumb. That's pretty massive. Somebody's done very well with pinning this expiration. Some non-pro customer actually is short a boatload of 55.30 puts. I may actually be able to figure out where this trade came from, but I can't do it on the fly here. I'll have to look through some notes and things, but it's a big trade, and it's strange to see these trades this large carried into settlement, but it is what it is. And you guys want to guess what my first instinct would be when I see this? Just looking through the lens of the pinning we talked about and the charm and all this influence. I guess I just gave it away, but I think we should open up lower tomorrow. I would expect that it would be very difficult to escape this range, because if we drift lower at all, market makers have a lot of gamma, ton of gamma. And so they're sitting atop this big, long strike. And the nice thing about this strike is that all of its delta by 9:30 in the morning will be 0, as long as we're above it. If we go below it, it'll have 100 option delta. Now, the unique thing about the opening quotation, or the AM serial print, it's funny because it's still called regular August. For example, when I was when I was trading, if I were to quote something and I quoted like August 14th or August 23rd, if I were to quote August, the broker would know what I mean if I said regular August, because it's an artifact of how the product first became known. And even now, I think AM expirations have a considerable amount more notional expiring interest than PM, but it's very irregular. It's actually the only AM expiration the entire month, but it's still called regular August. But what's unique about it is that it's the only expiration at that time. And so in the PM settlement, you have a lot of things going on. You have not only SPX PM options, you have XSP options, you have SPY options, and you have the whole array of stock products and ETF products. But in the morning, you just have these cash settled indexes, and SPX is the big one. And so the hedging flows around this position are unique in that they stand out because none of the other options in play are expiring. And as you remember, these types of really like sharp evolutions of Greek profiles that happen at the very last second. Oftentimes there's a lot of noise here because the entire options complex, the entire equity options, ETF options, index options, all of it is happening at once on a standard PM settlement. But during AM expiration, this is the only game in town. And so here, this is supportive. And so oftentimes you have to make the distinction because options are always conditional. There's a lot of dimensions in play. It gets more simple at expiration, but remember, this is a supportive position, but the flows, the passive flows around it are not supportive. Meaning if time passes, this is all going to be disappearing off the surface, and the delta that you own against it has to be sold out. So there should be support here. This is going to catch the knife because it's pretty big, especially in an overnight tape where there's not a lot of open interest. Someone stepping in to buy 9,000 plus futures price insensitive once they go through is a pretty big source of support when the tape might be 30 up or something. But again, because we're above it, if nothing happens, for example, and we're starting out at 55.45, whatever delta these options had into the close will decay away overnight, and market makers will be passively selling it out. And so that passively selling out of the delta will be bearish in a sense. So again, the position's supportive, but when you have a supportive position, the flow is the opposite. Where if nothing happens, it's actually unsupportive or it'll drag the index. But if something does happen, it is a safety mechanism. I feel like I've been saying the same thing in many places, but hopefully it's clear now. Yeah, exactly. Jack says this is just the numbers that you see in the horizontal bar chart. Exactly. I just want to deconstruct them a little bit more to understand the difference in some of the assumptions that I have thinking through the industry as I know it into AM serial Opex. Again, there's no perfect solution. There's no closed form here. There's 700 plus entities. And what they do, all we can do is generalize. I just have some opinions about how AM expirations work. And yes, I will look at PM positioning. I'll do that tomorrow on the pre-market call. Again, that's also a little bit noisier. SPX still largely dominates that settlement by the notional calculation, but there's other products in play too that aren't easily capturable. Some people ask the question, why isn't this easy to do on every exchange or with SPY or single stocks? If you think about SPY, for example, SPY is multiply listed. So you'd have to buy, first you'd have to verify that every exchange does produce the same data set, which they may or may not. And then you'd have to buy all of them and then normalize them all, clean the data, compile them, and do the same thing, all for a product that is maybe 1/10 the size of SPX. And so as far as 80-20 rule goes, you probably wouldn't care to do that project because it wouldn't net you a whole lot of influence in the end for the pain of trying to figure out the problems. That's my opinion. There might be some evidence to suggest the opposite. There certainly might be times where there are massive SPY positions in market, but a lot of the SPY open interest even is in a sense meaningless. There's occasionally some big trades that matter. Even as like a vol manager, I would have flagged a couple of them as meaningful, but a lot of it is, in my opinion, noisy. Yeah, so tomorrow, if I had to place a bet, I would guess at a drift down into a quiet settlement around 55.30. May or may not be the case. Anything could happen. But especially after we've wrapped up a lot of the data this week and had a nice long rally, I wouldn't expect a real strong or wide overnight range. I would expect a little bit of a settling down, and this should be influential. Okay, PS has a question. So as the delta from a supportive position decays overnight, dealers will have to sell the futures. That's exactly correct. You got it. Exactly. So dealers are long the puts below the money, and against that, they're long ES futures, which they have to passively sell back to the market as the delta disappears. And it can become pretty erratic as you get towards that 9:30 opening, because at that point, the options don't exist. So the dealer's hedge should be off their books. And the AM settlement is less liquid in general to transact across. The PM settlement, there's a pretty liquid BTIC market. There's a lot of reasons for owning or transacting futures marked against the close, not just in the options product itself, but all over the place. And that is a good source of liquidity for the dealer. The CME introduced the product BTIC. I think it was like maybe, I don't know, it was before COVID, but it was brilliant because before that we had to always go transact in the roll market and pay brokers to find liquidity, source liquidity. and pay spreads in synthetic combo trades. And then the CME came along and figured out that they had a great way to cannibalize or profit from some of the CBOE volume and put together the basis trade at index close and marketed it right to SPX options users. It was perfect. SPX levels versus ES futures. Yeah, if you guys can pull a link into the chat. I know we've talked about this a lot before. I don't have it handy, but if you guys don't have it handy, I'll put it in. It's just the BTIC contract is offered by the CME. It goes by various tickers depending on which feed you're looking at. And yeah, no, I'm not saying this is much lower. I'm just explaining that this is a high probability influence as we approach the settlement. And so if we don't really get any higher and escape this range, it looks like we peaked out around 55.80 so far this evening, but we're $10 off the high. So if we drift a little bit lower, that delta will again come back into play. But again, if we stay here, the delta will disappear anyways. And so if we stay here, or let's say we fast forward the clock here like 7 hours and we're trading 55, 75 or 79 at the top, whatever, a lot of that influence could be written off. And then just to speak a little bit to the mechanics of what happens next, it's oftentimes discussed as a window of weakness. I think in some sense that term is decent, but it also may be capturing too many things. Properly, what's happening is just an unclenching. Gamma just comes off the books. But the reason why this moment with expiration during the serial, the third Friday, is important is because of the way the end users use options. And so what I mean by that, if you just break down the options calendar, and if you imagine it as a series of weeks and days, you can always go back in your mind and think, okay, options selling strategies that are systematic and quantitative, they sell every single day of the calendar. That was one of the beautiful things that the CBOE did when they unlocked Tuesdays and Thursdays, so they actually gave quantitative strategies a much more robust landscape to trade, because previously you would always have concentration problems because you couldn't necessarily spread your bets like you'd want to if you wanted to operate like a casino. It always drove me nuts. And as a market maker, it was funny because from my perspective, I wanted them too, because I want to be able to hedge my term risk. If I had a more continuous vol surface, I had a cleaner position. And obviously when certain users only use portions of the vol surface and other users only use a different portion of the vol surface, as a market maker, you have an advantage there to arb those together. The point I want to make here is that every day is sold by quantitative, systematic short vol strategies. Every day of the calendar is sold. But then you have a bunch more selling that happens on serial Opex. There's a couple of different funds still pretty popular. I think Natixis Gateway Fund is a big one. They only operate in maybe they do Fridays too, but it's mostly concentrated in AM expiration options. And you also have XYLD, for example, the Global X ETF that opens up a new buy right program every cycle. These are just a slice of the types of funds that do this. And it maps back to that old 30-day option cycle where really you only had a few options to trade on the calendar. These funds just never calibrated or evolved. They just have stuck to their ways. And so you have a lot of concentrated inventories that happen on the serial expiration, which is tomorrow. Beyond that, there's still hedging that happens, right? And so end users typically will want to hedge systematically, and they'll have a basis to try to match. And so that's why, for example, the JP Morgan put spread collar, that trade is massive. They do run one every month, but the most massive one is the quarterly. And then if you look at the end of the year, there's a massive amount of open interest in December, all for these same reasons, because the benchmarks that people care about are end of year, end of quarter, and end of month. And so if you go back to the idea of looking at the options calendar, every day is sold, and there's that natural imbalance that winds up happening because no one is coming in systematically to do things like buy Tuesday options. It doesn't happen. Nobody cares. There's not a single thing in the world that maps to a Tuesday basis. Nobody cares. You care about the end of the month or the end of the quarter, end of the year. And so if there's a window of weakness, it's because hedging happens in options toward the end of the month. But primarily, what that looks like when all the dust settles is that you have like a wet blanket of quantitative investment strategy type flow that's dragging the vol down everywhere across the calendar. Then you have extra weight on the serial side. And you have a little bit more balance coming from end of month. And maybe there's a little bit less gamma that should be implicitly there because of those strategies at the end of the month. That could make an argument for using the term window weakness. But again, strictly what happens is that chunk of gamma that is coming from these more traditional overwrite and buy right and put right strategies, that disappears on Friday. Now, it doesn't really disappear. It usually gets rolled. But the rolling, obviously, even if you take the exact same amount of contracts, but you strip them out from the 0 day and put them out 30 days to expiration, the gamma disappears effectively. Now it has some vega to it. It's a VIX type option instead of a 0 day. And so that's that unclenching. It's the disappearance of inventory plus the rolling out of inventory. But yeah, so Jack put some things here. Natixis is a cool one. That fund, it was always fun to trade against because of the way they operated. They used to be called the go around. If you were a market maker on the floor, it was the one trade that you always understood the direction. It was so easy. The inventory was easy to track. They would have 9 or 10,000 options clustered at a certain strike at a certain maturity. And the brokers would be super excited when they got the order because it was always the same way and easy to execute. And so they would quote it. Everybody can just lift your offer on these call rolls. So these guys do produce a pretty sizable impact when they trade because they're sloppy. And when I say sloppy, what I mean is they just trade live, not hedged, and they just throw the whole block into the mix at once. And so they come to the floor, they quote it, and they buy 5,000 of the different structures at a time or something. I think it's less now. It might be like more on the 2,000 mark. So if you see spreads where, if you guys like watch flow or use flow spotting tools or something, if you ever see spreads that are traditionally like one call versus another, horizontals, and they usually come with a put spread, and they're usually between 1,600 and 2,100 contracts in each one. This is probably this fund in market. Their website actually probably has their inventory. XYLD is the one that will strike tomorrow. And what they do is they just come to market after the AM settlement. They sell to open the next block. And so what they do is they start at like 11 o'clock or something, and they say, okay, where's the SPX trading? The next strike above, they just sell that. And they do it as like a VWAP trade where for 2 hours, they're just pitching 15, 16, 17 lots into the customer order book. And it goes by under the radar. So it's almost invisible unless you're watching for it. I think flow spotting tools probably could be good, but the attempt to tag the direction of the order flow is a problem. And that muddies the water. For me, I rely on knowing which strategies are in market, which I get is hard to say you guys should just know what the strategies are. My initial intent when I built out this mentorship and Discord was to really bring to light some of the stuff that you can't easily know unless you've faced it or managed it. Oftentimes what I do now with flow spotting is I just literally look for blocks of certain sizes, or Bloomberg has some good tools, but I know that's probably too expensive for most. And really you can't unlock the value unless you're doing certain things with it. Most days I'll even just leave up something as simple as Thinkorswim and just use a descending quantity to look for big blocks that I know are interesting. Alternatively, I do actually like CBOE's trade alert service. I think it's $370 a month or something, but I do find it's pretty handy reference to summarize the trades. But again, Jack's point, they can be useful. It just depends how you digest it. The mistake people make is just like signing up for unusual whales or cheddar flow and assuming that you're getting something good when you're just being misled by aggressor tagging, which just isn't functionally correct. You also get misled all the time because of things like rolls and boxes. For example, a roll happens all the time. I laugh so hard when I see people with data services talking about open interest on the 5,000 strike or the 6,000 strike. It's completely benign because what it is, it's a giant combo trade that's held against either another combo in the same tenor and then swapped against the combo longer dated. And that would be a box trade where you have something that expires into a certain payoff. It's a certain payoff and there's no early exercise. So it's basically a zero coupon bond. There's nothing there that's going to give you anything actionable as far as a bias or flow or direction or volatility. It's just a zero coupon bond on the books. Yeah, it can be interest rate arb. It's also, you can think of it as like an avoidance of being arbed, because as a trader or market maker, if you're managing your margin, it's common to run into issues when you have cross margin where, for example, if you have an options position and it's hedged and the market runs a certain way for any extended period of time, which it tends to do, you wind up receiving cash all the time on the ES portion or paying it, but you don't really get anything back on the SPX options until they expire. And so there's always this kind of tug of war with managing your cash balance. And of course, your clearing firm charges you a spread. And so the SPX pit just winds up being a settlement feature where you can avoid going to your clearing firm and paying their spread. And I think some former market makers figured out that this is a good venue to do that. I actually know somebody who went off to do this in the agricultural space to teach farmers how to hedge their own cash balances into SPX options. And then I've seen that there's an ETF that does this too, called Box, BOXX. But just to that point, the flow spotting services, to wrap it up again, you wind up seeing a lot of stuff that's not important. And unless you understand the context and are able to like put it out of mind quickly, when you see, for example, right now, it would be like an August 5500 combo, long call short put, and then a September 55 combo. It's very easy to see, oh, 5,000 of these trade. That's a big order. And I always get asked, is that a straddle? Like, no, it's not a straddle. Nobody trades even 500 straddles. It's a once in a blue moon trade these days. It's always combos or boxes. Okay, so now for the AM position, that is a pretty big number on the 5530 puts. That's larger than some of the expirations I've seen recently. But other than that, there's not a lot of risk here or anything to worry about, especially if this turns out to be the more in-force type of position. Going back to the ES range, the top is 5579, which actually would make more sense through the lens of understanding that there's positive gamma in the market up here. Which again, I don't want to overly confuse here. This is just an artifact of how to construct these things. I tend to think that at the end of the day, if there are dealers and firms that are left with inventories into expiration, they're going to be hedging those. So PS says, the idea behind pinning and the call walls, the AM expirations all made lots of sense. Can you discuss some other frequent, repeatable phenomenon for dealer flow? Yeah, so what I want to emphasize is this stuff is not magic. There's not so many dimensions, right? And so if you really understand one feature, for example, if you just understand the mechanism of the call wall very well, if you just flip that upside down, that's a put floor as far as the dealer's hedging flows go, right? It's the exact same mechanism, but from a different side. So it gets a little more complicated when you talk about volatility dynamics, especially different calendar spreads. It gets a bit weird and hard to talk about without specific cases to discuss, to weave through, because it's more dimensions. But as far as gamma hedging flows, very much true that it's either one thing or another. It's either positive gamma or negative gamma, and it's either a lot or a little. And then you just place it on the map and observe how price should behave around them. For example, if you have the idea of a call wall, you understand it very well. Now just invert it, flip it upside down, and imagine that it's below spot. The same thing is going to happen. The same charm influence will pin the dealer's long. All that stuff is strike dependent, right? It's strike dependent and relative to spot. And so you can understand the general concept and then configure it in different ways. Now, I guess to that point, I don't often talk about the dealer negative gamma case as much. It's probably just because it doesn't show up as much. But it's, again, the opposite in terms of how the influence is exerted, right? And so for a dealer that is short, for example, if you flip the call wall that we had today and go back to this position here, this beautiful kind of ladder, and treat it the other way, the dealer would have to buy an increasing amount of futures here. This is interesting because I've thought about this type of position in the market from the other direction a lot. I always wondered how long it would take to show up. Whenever there's a weakness in the market, it's just a matter of time before it does cause a problem. If you had a ladder feature like this in the market the other way, in very far out of the money options, and built this layered position where the amount of gamma in the market increases, here it's stabilizing or mean reverting, slowing the market down and stopping it. But if the opposite were true, you could have some pretty violent moves through. And again, here, when the dealer has positive gamma because the customer sold them options, if you imagine an order book, this is why I like Squeeze Metrics, he put together something called the implied order book. I liked the way he thought about it. If you imagine an ES ladder with the dealer present, you're going to have futures stacked on the bid and the offer because that is what they need to do to bring their delta back to delta neutral. Just the act of moving the market up $1 means they can sell futures and it will, in theory, lock in P&L for them. And that's all automatic and systematic. If you flip that and take them out, a lot of that volume disappears. And on the opposite side of that, if you actually flip this position and make it a customer long and a dealer short, where now the dealer is short gamma here, not only do they have no contribution to the depth of the order book, but they have to take liquidity from it as the market moves. And so you already have a thinner tape or a thinner book depth, and they are coming to market buying futures on the rally at an accelerating pace. Really, who else is going to step in and sell? You can get very violent moves when there's a lot of negative gamma. And I put out a meme earlier on Twitter about, oh, welcome home. Because if you look at the gamma profiles that we've experienced, we've run up into positive gamma every day, largely coming from 0-day positions. Now, along the way, we've run through either negative gamma or very light dealer gamma, where it's almost inconsequential. I suspect that after today, it's going to be long gamma pretty much across the board. Maybe the unclench that will happen after tomorrow's expiration will be a little bit of a lightening of it, but I suspect that we'll see a lot more blue on the options depth charts in general, starting on Monday, Tuesday, etc. PS, it says a question about a couple days ago. I think it was Tuesday where you mentioned that we had a call wall from 5400 to 54.5, which should serve as resistance. Yeah, that was again a similar type of ladder feature in the market. It wasn't as clean as this one, like in a clean ascending ladder, but I think the dealers owned a lot of calls at 54.5, maybe even more than this. I think we settled right into the longs. Ultimately, the strongest resistance is going to be on that last point, right? Because they've chewed through gamma here, and it doesn't have to reverse the order flow, right? It doesn't have to overtake it. The buying doesn't have to exhaust and revert. It could just abate. And so there's a stronger and stronger force in motion, a wall, a call wall. And in the end, there is that kind of trapping. If you can bring the options inside of 20 delta, it gets like this gyrating feature where the balance of gamma and charm do have a gravitational kind of pull towards the strikes. It does provide resistance. And you can see that clearly in these charts. If you look at the intraday price action as it evolves, you can see the collapsing of the price bars. That doesn't mean there won't be volatility still, because there's other things going on. It's just an overlay that's the feature in the market. If it were not there, you'd see a different outcome. You have to synthesize everything. This is not the only thing in the market. I would expect that if it were the only thing in the market and some buying flows ran up against a call wall feature, when they exhaust or turn around, or if there's any mean reversion, the move lower technically should happen as a more accelerating move because the gamma is asymmetric. If we revert this process because it's strike dependent, it's not symmetrical. When you revert off the strikes, the dealer is buying, but they're buying less and they're buying less and they're buying less. And so the impact might look different. Again, it's not the only thing in market. The selling flows that came out of CTAs helped actualize or make that move lower materialize, but now they're dry powder again, right? Because they did lighten up their exposure. They were at max length. When they sold out futures, they now have ammunition to send us higher. And especially in these moments when people are waiting for resolution on macro or risk, these mechanical drivers can be seriously impactful. Recently, especially because volatility is coming from higher levels, think about what happens as we have these vol spikes. When customers come in and buy downside options and drive up the volatility of these put options, dealers are selling futures against all of this. Now, they get short downside gamma and they get long Vanna, which does two things. As we rally and the volatility comes off, especially because it was a vol spike and not a natural kind of move, as the vol comes off, the amount of hedging that they had to do against those options, even though they're not expiring, even though they're not zero dated, they might be October, December, whatever, when a significant amount of vol comes out of those puts again, that does fuel a buyback of the hedges too. So if you look at some of the flow notes that have come out from the different desks after hours every single day this week, the flows are light. Nobody's doing anything because nobody knows what to do. Everybody's going to be a deer in headlights because why make a decision ahead of what would be an important macro moment, right? And so if you think about that, a lot of macro books, they don't care about a 5% oscillation. But if they're just stepping out of the way and looking for resolution, then these mechanical influences are doubling up their influence, right? Because it's the fact that they're present and they have dry powder as other flows take a backseat and just wait for things to happen. Like they wait for CPI, for PPI, for sentiment, and they wait for a resolution of Jackson Hole, because whatever it might be, if there's some reason to wait for more clarity on the rate front, then these other flows take precedent. I think a lot of the move is already exhausted. Obviously, it's been unwound, right? And so the question is about what's an upside target. I would think we would test the all-time highs. I don't see a strong case to blow through them. And I don't think that lowering rates because data has inflected to the downside relatively quickly is necessarily a good thing. Jackson Hole is not going to tell us anything that we don't know as far as how the economy may or may not be doing. It might just give us insight into what those rate setters are thinking about their next response. But really, ultimately, it's going to be a situation where people are going to be looking more towards employment because the distribution of outcomes for the forward path at this point is very different if we have a little bit of an adjustment cut, but no recession. Whereas if we do have any kind of weakening economy and rate cuts, very different path ahead for stocks historically. So if I think we're mechanically squeezing, I don't think a lot of the fundamental liquidity issues are resolved, and I'm not too bullish on the glide path that people bought into, then I think that it's a great opportunity to hedge because things will get abnormally cheap because of all these influences overshooting, especially into VIX expiration. Then I want to use that opportunity to buy things a bit cheaper than you might be able to a week later. Options Against Humanity says, can you go over structures versus the profile? Yeah, so I'm going to release a bunch of videos, some by Greek and some by profile. But the point is to go over how I look at them all and show a bunch of times they don't work as well, because I think it's super important. I need to attribute the person who gave me this little heuristic because it was great. It was knock 3 times or something. Basically, get out of the way. If the price fades off and keeps rebounding and pushing that gamma, that's a serious program in force. It's not going to just disappear because we faded off the level. It's some kind of price insensitive flow. And those used to be the times when I was less aware of what was going on, where I would just get run over because I'd be like, why isn't this stopping things? We just keep grinding the offer. And I learned not to fight it, but actually to ride it. There are some cool things you could do. Whenever I would see features in market like a big call wall, I would tend to do things like sell to open call spreads early in the day above the call wall because the gamma should slow you down there. I'd expect to be able to close that out or that it would not really run into the risk of settlement. But on days there might be something in force, I like owning net units because sometimes you get these days where a real sizable bid in the market can just blow out the implied range. And so you have calls that started the day at 10 cents winding up with $30. Also talk about color. Oftentimes too, one of the cool things is that market makers cannot price everything finitely or discretely. And so the option surface is like a sheet with different nodes all over it, but at the end of the day, it's continuous. So if you're starting out with a very heavily long GEX environment, the map is all blue in options depth, and we're way high atop the peak on the cartoon naive GEX chart. There's not a lot of movement. That should also make options very cheap. You'll have times where color shows up and the chart evolves. Let me just actually pull this up really quick. Like this type of thing here, right? This was not the best example of this phenomenon because the vols got pretty high. But on a day we didn't drop 2%, these options would be priced pretty cheap because dealers would be swimming in gamma, long options everywhere, and that acts like a wet blanket on the vol surface. But as you go towards expiration, there might be a 0-day feature where you'll have cheap bets because of the continuity of pricing, but all of a sudden your odds change significantly because of what happens right here. And so obviously a dealer's model is not doing this. I promise you guys. As a market maker, you might look at this stuff and it might be interesting, but you just can't functionally bake it into your process unless they've solved this at Citadel's layer or something. I don't know. You just can't respond so finitely. And you're also responding to order flow as it happens. So these moments where you're buried in long gamma and everything is very cheap, suddenly things change, dynamics change. And as a dealer, it would be frustrating because you feel like you get picked off, but obviously you're getting lifted out of long inventory. It's not exactly picked off. But the market character changes because of what happens to your position here. And those are cool things to wait for and to look for. Same thing happens on the other side, where if we have a range of negative gamma, there will be times when a large 0-day position comes into play and it's just like a magnet for a charm pin. But you get to sell higher premiums because of this beautiful feature that everything's expensive because dealers are short all the options. Someone says, I heard from someone that customers often run pain trades on market makers. Is that true? Okay. So that's an interesting question. These are just mechanical influences. If I think back to some interesting moments in my career, for example, I won't name the bank, but it was a large firm at some point, maybe circa 2013. At that time, the weekly option was the gamma intensive option, which is hilarious to remember. You'd have the front month option, and then you'd have the next month option and the quarterly. And you'd have one Friday expiration. So very limited set, very easy to track order flow in a domain like that. So the gamma option was the weekly option. And so just imagine, for example, let's say right now we're trading 55.5 and vols are pretty low. Let's say I'm on the trading floor and a customer comes in Wednesday at late afternoon. They would quote up like a 55.80, 56.10 call fly. And this call fly might be worth $1.30. They paid 160. Your job as a market maker is to just sell it as many times as you can. And so you do that because it's a ridiculous level. You cover some of it, but you couldn't cover the size because they'd buy 10,000. And then you come into work on Thursday morning and magically futures somehow got to the middle of your fly. It was strange and really painful and a pretty interesting learning experience to sell this thing for like $1.60, wake up, first quote in the morning, you're making it $7 at 780, and they come in and sell it back to you, and you're all looking at each other like, what the hell just happened? Oftentimes it'd be worse than that because you'd actually get stuck and they would quote it throughout the day and you'd all just hate life making these markets because everybody within arm's length of you, you all sold 500 to 1,000 of these. And you're just doing the math in your head. Okay, that's a lot of money. But your own influence too was very obvious. The futures would get stuck on the middle of your fly. When I started to watch it more closely, it was very clear why they were doing what they were doing. And there was some way to nudge futures in the overnight, which was very liquid at the time, to get the market in range. And then our flows would take over in regular trading hours. That was a pretty brutal lesson. Eventually they stopped because it stopped working. I think enough of us caught on and calibrated a little bit. This stuff does happen every now and then, less so now because the market is very deep and very liquid. But it will happen at some point. We'll be having a morning call about how ridiculous the 0-day blowout was. It will happen eventually because it can happen. The question is back to the repeatable flows thing for a second. Does the opposite of call walls and put floors serve as a repeatable flow? If dealers are short puts that go from out of the money to in the money, does that lead to acceleration down? Yes, it does. And so you, in theory, would squeeze through. I would point out the natural course of business is buying. Unless there's some kind of liquidity event, the natural thing is buying. And so as time passes, buying happens. And as the index drops, buying will come into play too. You tend to think that your biggest wins would be to the downside because it's a contrarian thing to make money as a bear. But some of the best trades in my life really are upside. And that happens because upside options are priced cheaper anyways. But there is not a lot of natural selling. When you have a negative gamma range in effect to the downside, you have to keep in mind that, yes, price will squeeze through because of negative gamma. That dealer is there doing the job, selling futures, pushing it lower. But then the entire world is waiting with bated breath to buy the dip. It's much more frustrating, in my opinion, to try to make money on downside negative gamma squeezes. It's much harder to actually monetize those, in my opinion, tactically. When you get a negative gamma range to the upside and we squeeze through, you can just put your hands in your pocket because there's no natural seller. So if you go through this exercise 2,000 times or whatever, you'll just pick up on these tendencies and have this heuristic, okay, just let it go. Let these moments run. But also on the opposite side, there's always a race to monetize dips in some way or another. Someone's asked, given how the market's evolved, do you believe bear markets are shorter than they have been previously? They're definitely different. It's difficult to compare one market to another. For example, a bear market that we experienced in the 70s before I was born might be different than a bear market now. And maybe in some ways, what we've experienced, even in our quote unquote bear markets, are not so much fundamental or macro driven, but more technical features. It's hard to say. But yeah, they're very sharp. You get these quick Vs that are almost like you blink, you can't see it. We just went through one. It obviously was not a bear market properly, but the dip and the return felt like a microcosm of what happened in Halloween of 2023. But even COVID, for example, I think it was around expiration in February of 2020, just watching the futures ladder, it's like someone dropped an axe and nothing was going on and there was no explanation for it and everyone was confused. But obviously the writing was on the wall if you're paying attention to what was going on. But even then, if you look back at that flow, it disappears so fast. So I do think that, but I wouldn't be surprised if something changed and a real fundamental macro type of evolution reminds us in the next 20 years that no, it can be a real grinding market too. There's a lot more information and everything is automated and systematized for better or worse. In many ways, it's a sweet spot because a lot of the people playing at the table have their cards face up. I remember being on the floor in 2008. We'd sit on the floor and wait for the phone to ring. And it really felt like a funeral. And actually at that time too, I think it was Vic Niederhofer put on a crazy position, a beautiful position. It was a 1x2 put spread type structure where they kept buying like the June of 2009. The 600, 900 put 1x2 and the 700, 1000 put 1x2. And they kept buying the one, the top of the structure and selling the two. And if you guys know what happens with Vanna, this was my introduction to how painful Vanna can be. I'll never forget, I think it was the March contract. We had sliced through all of this inventory, the 600, 900 put 1x2 that we had sold for crazy edge, meaning these puts had very little premium. And we always thought, okay, well, you're buying a risk unit, good trade. It's so far off the surface, you just don't care about it, but you wind up caring a lot about it. You sell through it and everybody's blown out by that point. Nobody's trading. Your morning meetings are basically talking about, what if we sell the 200 puts? If we go there, can they even collect? With this one guy, just nailed it. And we would just bleed out. Really high vols, and you had Vanna the wrong way, meaning we were short upside options, long downside options, had massively overinflated volatilities. And when the air came out, we just kept sinking towards that fateful low. COVID happened faster. In COVID, you'd see flow like Taleb's type of structures where they have similar types of trades that they actually never intend to go through. They buy put 1x1.5 structures. They never intend to go through them. His thesis is that the tail that you sell on a ratio cannot technically perform as it's priced, whereas the tail that you buy does have the right Vanna exposure for a real crash. It's just a matter of how often they hit. I mean, it was very unstable. I'll just say it was incredibly unstable, and it was very difficult to know what positioning was at the time. Even your own position was very difficult to know at the time. When you think about how ridiculous it is to have a 1-year straddle move $200 throughout the day, it's just incredible pain for anybody trying to balance their delta. No, the reality was a complete shit show. I thought it was a lot of fun, and it was interesting to see how things actually are not very well mapped out at institutional levels or exchange levels, where you assume that the parents have it under control, that when you see that kind of happen and no one's really paying attention or adequately prepared, it's a reminder that there's risk out there that you can't see. But that is a rabbit hole that I won't spend too much time on the call because we're pretty much at 10 o'clock anyways. But if you guys are in the mentorship, then Saturday we'll have a Q&A also, where I'll talk a lot more about trade structuring, what I look for to find these trades, given different vol levels and the types of things I think about when I'm building these trades. Cool. See you guys.